back in the day, not that far back, gold and platinum were 1-to-1. Platinum's $1,200 or whatever it is. It was like $900 when I started talking about this. $1,300 an ounce. It should be 1-to-1, 3,400, right? And in fact, if you go back another 5 or 10 years, it was 2-to-1 to gold because they only make 200 ounces of it, 200 ounces, 200 tons of it. And the same with palladium. So they really don't make any of this stuff, and it's coming back into fashion, and it's a precious metal. So it's logical that it will have a renaissance, and it will, do very, very well. It will start to catch back up with where gold is, which is likely to also to be going up as well.
In contrast to gold actively accumulated by central banks in China, India, and Turkey, or silver, where demand from solar panels and electronics is surging. Platinum doesn't have a widely perceived urgency in the current economic narrative. Historically, platinum traded at a premium to gold. That changed after the 2008 financial crisis and diesel emissions scandals. Since then, this metal has struggled to regain its elite status. In 2025, it continues to play the underdog role in the precious metals market. Renowned technical trader Clem Chambers predicts a potential renaissance in palladium and platinum, noting their extremely limited annual supply, only about 200 tons each compared to 320 tons of gold and 25,000 tons of silver. He notes these metals once traded above gold and predicts a strong upside if they return to historical price ratios. At the beginning of 2025, gold surged to new highs above $3,500 per ounce. Silver followed closely, climbing toward $38. In contrast, platinum barely broke past $1,300, despite a sharp rally from 2024 lows. On paper, platinum had a better percentage return year-to-date, but in absolute value and investor enthusiasm, it still lags. While reflecting on fundamentals, Chambers emphasizes gold's role as the currency of war and suggests that a weakening dollar will support gold. Unlike Bitcoin, which is suited for quick escape, gold remains the trusted asset for state-level security. Moving forward, Chambers cites rising global tensions and central bank gold purchases like Poland's as evidence that governments are preparing for possible conflict. The World Gold Council's May update reported net monthly purchases of 20 metric tons, led by Kazakhstan with 7 tons, followed by Turkey and Poland at 6 tons each. A 2025 survey by central banking publications, covering over 91 central banks managing $7 trillion in reserves, found that none held Bitcoin. Only 2% expressed any intention to invest in crypto assets within the next 5 to 10 years, down sharply from nearly 16% the previous year. Before we dive into Clem Chambers' sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market.
Really spicy and equally as fun potentially, because Bitcoin is a speculative, high speculative asset. I would be in palladium, and palladium is something I've been talking a lot about. That platinum, palladium, they make 200 tons of that a year. It's the demise of platinum and palladium because of internal combustion engine going away. That's a dead duck now. And they only make 200 tons of it. They make 3,200 tons of gold. They make 25,000 tons of silver, 200 tons. So any turnaround there is going to be, absolutely ballistic. Back in the day, not that far back, gold and platinum were 1-to-1. Platinum's $1,200 or whatever it is. It was like $900 when I started talking about this. $1,300 an ounce. It should be 1-to-1, 3,400, right? And in fact, if you go back another 5 or 10 years, it was 2-to-1 to gold because they only make 200 ounces of it, 200 ounces, 200 tons of it. And the same with palladium. So they really don't make any of this stuff, and it's coming back into fashion, and it's a precious metal. So it's logical that it will have a renaissance, and it will, do very, very well. It will start to catch back up with where gold is, which is likely to also to be going up as well. So you've got a double, almost a triple whammy, and they don't make any of it. 200 tons. I think the average American family uses 50 tons of stuff every year. So that's how small 200 tons is. An American family will chew through 50 tons of, I don't know, Amazon boxes or whatever. And so 200 tons is basically nothing. I have a slightly different model. Gold is for war. Bitcoin is for flight. If you're going to run to the airport with 100 million, you're not going to do it with gold. You can't get it on the plane. It's too heavy. It's a ton, isn't it? Whereas Bitcoin is a smart stick. And in fact, you don't even have to do that. It can already be gone on some exchange somewhere. So if you're going to if you are the minister of plunder at some country and you think that things are getting a bit spicy for you, you put all your liquid into Bitcoin and you get on the private jet. And Bitcoin is for flight. Gold is for war. Gold is for war because central banks buy it as the currency of war, because in a big war, or even one that affects you, when you start to want to buy stuff, minerals, weapons, etc., all of a sudden the other people that will sell it to you for your paper start to say, oh no, I think I need gold, because gold is the currency of war. So, if you are going into this never decreasing cycle of stress that we're seeing, all the countries are laying in gold. I mean, you can even see them emitting it. Poland is buying gold. Oh, why would Poland buy gold? I wonder. Yeah, because gold is for war. And you can't buy it the day before you have a war. You've got to say, likelihood of war has gone up a little bit. Need more gold. Oh, it's gone up again. Oh, need more gold. You can be a long way away from that war, but as you step towards that situation, as you go down that path, you've got to load up on gold. And that's what you're seeing. Various countries loading up on gold, and that's what's driving the price. Yeah. But if you are in, the minister of monkey business in some country, and all of a sudden, someone might be dropping bombs on your head, it's the Bitcoin that you go for. And then you will see the price move. So you will see the price of Bitcoin ramp up, and then literally days later, you'll see some sort of conflict or some sort of, outrage or some sort of emergency occur. Well, I mean, I think that obviously Powell is a brake on inflation, although everyone claims that he caused it in the first place. But he doesn't cause inflation. The government that runs deficits cause inflation. And it's his job to keep the train on the tracks. It's his job to stop the wheels coming off. And, he has been fighting the inflation that was created because of the way COVID was handled. And he's got the money supply down, and he's got the balance sheet of the Fed down in such a way. If you go look at the Fed balance sheet, you can see they've really ground out the balance sheet of the Fed. And they've really, they did QT. So the first thing he did was stop the QT. So that was his first move towards cutting interest rates, his first move to maybe placate the new administration. Because QT is the thing that makes things difficult, because it's sucking cash out of the system. And obviously, the less cash there is to play with, the harder it is to play the economic game. But interest rates are going to come down, and they are going to come down quite a bit. And, the dollar is going to be weaker because, Trump wants the dollar weaker. The dollar is way too strong. If you look at the way the dollar is priced against other currencies, other fiat, it's way too strong. So you will see the dollar coming down, and that will be, won't help inflation. There's going to be elevated inflation for, until further notice, 4 or 5% of underneath the hood. When you go down and go, hold on a minute, we've only got 3.5% inflation. It feels like 6. That the sort of inflation that we feel, but are told isn't there, that's going to be elevated for quite a long time, because you run big deficits. You got to print money. And if you print money, you undermine the value of money. And that's what we're seeing. Not necessarily the tariffs, but certainly the dollar coming down. Yeah. Tariffs is a tax. So, that could help keep the deficit under control, or, not so out of control. So, there's the thing about all these predictions and why so many professionals get it wrong is there's so many moving parts. And sometimes, it's quite easy for something to have the absolute opposite effect of what everyone's expecting. As we saw with QE, everybody said QE was going to be inflationary, and it wasn't. So what we will see, I believe, is a double whammy as far as inflation goes, which is big deficits and the necessity for a falling dollar. So there will be elevated, not runaway, not incredibly terrible inflation, but elevated inflation 1, 2, 3 points above the 2% target.
Some analysts are seeing signs of a bubble this year. Many stocks are priced with the view of a sunny future. However, storm clouds of uncertainty are forming on the political and economic fronts. Market expert Clem Chambers claims U.S. markets are being propped up by Treasury-driven price support, not the Fed. He mentions this suppresses volatility and distorts price discovery across assets like gold and equities. Chambers warns such intervention may fuel a Nasdaq bubble. When it bursts, the crash could be severe. Over the past 20 years, gold has significantly outperformed the S&P 500 index. During this period, the ROI for gold was 616%, while the S&P 500 index gained 421%. The report states that while part of gold's recent outperformance is due to the 2020 pandemic crisis, since 2022, gold has become a regular outperformer. Concurrently, Chambers believes that despite Trump's public negotiation tactics and tariff threats, Europe is moving toward greater independence. Chambers views this shift as healthy, highlighting Europe's comparable economic strength to that of the U.S. He believes the region is ready to handle its affairs. The outcome, however, remains uncertain. Let's get back to the interview.
It's very, very interesting, and I'm sorry I'm going to sound, I better put my tin hat on here, because this is market manipulation by the government. Now, if you look at the market after the tariff crash, it's very, very, very low on volatility. And, if you look at the right charts, before that, you see a lot more week-to-week volatility than you're seeing now. It just goes straight up, smooth as a snooker ball. And, that's the sort of lack of volatility that tends to come from manipulation, price support. Because when you have price support, whoever's supporting the price basically absorbs any selling and is just, moving the price. Anything that would push the price down, it is absorbed. And, that's coming from somewhere, because you can't tell me there's good reason why there should be less volatility in the American stock markets right now than there was, say, 18 months ago. Well, I don't think it's Powell this time. Obviously, the Fed has been very much the guardian of the stock. I think it's coming from the American Treasury, that all the signs seem to suggest that it's the American Treasury using its levers to, pump liquidity in to the market to keep it on track, or in fact repair it. But now it's repaired. Now the prices are kind of back to where they were before the tariff crash. It's interesting to see what will happen, because if the prices are just being supported to get you back there, well, that support's going to go away, because support is expensive. I mean, generally, it's very expensive, unless, of course, the support is right about where the price should be, as you see happen after big crashes. But you can't go on supporting it from day to day. So it will be interesting to see whether the day-to-day, week-to-week volatility returns or not, now that we're back to those levels. And I wouldn't be surprised if we don't start to see more lumps and bumps in the market. But I have said for a long time that there's a Nasdaq bubble coming, and we've been in a pre-bubble end of boom phase. And, I would not be surprised if the Nasdaq doesn't go into some sort of insane bubble phase. And, if it starts to go that way, people can say, oh, somebody said it's going to go into a bubble. Oh, great. Let's do the bubble trading. But remember, if you go into a bubble, it ends and then you get the crash. So if we do go into a bubble, bear in mind while you're having a good time that music will stop, and it will be a really, really, gritty time when it does. Kind of went away 2010, 9-10, because, when we had the financial crisis, the governments of the world came in and they bailed everything out and they propped everything up and they kept it there and let it repair itself, let the injured patient, recuperate. And you saw that again in COVID. I mean, without massive government intervention, the world would have been a smoking economic crater, for sure, absolutely for sure. But they stepped in and did massive, massive interventions. And, that is, they haven't really got out of the habit of that. And maybe nothing will ever get them out of the habit of that. And that is actually makes it very difficult for price disclosure, and it means you have to have a very, very clear view of what you think's going on. Well, I mean, I think Europe's position is, don't rise to the bait, don't be trolled. If it happens, it happens, and they're not going to buckle, they're not going to bend, and in fact, they've been told to get on with dealing with Russia, and that America's not going to help them there. So as there's this detachment from the old style of America really almost leading, in fact, actually leading Europe, and that Europe's now meant to be big enough to look after itself, etc., etc. Well, they're going to do that. And I think that's really, really good for Europe, because ultimately Europe has got a bigger population than America and roughly the sort of same GDP in terms of per head and purchasing power. Now, GDP in dollar terms is out of whack. And GDP of Japan in dollar terms is out of whack. And that's because the dollar's too strong. But obviously, when the dollar starts to come down, you'll notice that in economic power, Europe is pretty much similar to America. And Europe should be getting on with it and should be doing lots of systemic changes, which they'll have to do now, which actually America is doing. So, this is all just a change. It's a new era. Europe is going to be standing much more on its own 2 feet, and it's not going to allow itself to be trolled by America. And, if Trump wants to put X% on, well, it's probably his loss in their mind. But we will see. But if you look at the last few months, what Trump says he's going to do, it doesn't happen. He's basically negotiating in public through Twitter and Truth Social, which is utterly new way of doing business. And, it's quite effective. It's certainly incredibly entertaining. Best of luck to all parties, because frankly, we want the best outcome for everybody. And, who would be unhappy with Trump actually pulling off what he's trying to pull off? Well, nobody should be unhappy if he pulls it off. Now, if he makes a complete pig's ear of it and an economic and geopolitical disaster out of it, obviously that'll be terrible. But, we still don't know, do we? And if anybody tells me they know the outcome of this administration, then I would like to, have a look at their crystal balls.
Central banks continued adding to their gold reserves in early 2025, with first quarter acquisitions surpassing 244 metric tons. Exchange-traded funds linked to gold also saw renewed demand, drawing nearly $30 billion in inflows, a level not recorded since 2020. Billionaire investor Ray Dalio advised allocating 15% of a portfolio to Bitcoin or gold, citing mounting concerns about U.S. debt and potential risks of currency devaluation. Gold is typically a good investment if you're looking for a way to safeguard your wealth, protect against inflation, and diversify your portfolio. But you might also consider investing in other precious metals, too. Platinum has not caught up with gold and silver in 2025 due to weaker narratives, cautious investor sentiment, and limited media focus. The industrial demand for platinum is not strong enough on its own. Meanwhile, the precious metals market trends favor gold and silver due to clearer stories and deeper liquidity. As central banks double down on gold and rare metals like platinum remain overlooked, are we approaching a historic revaluation of hard assets? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.